Good evening, everybody. It's 7 o'clock. We are just waiting for a few more attendees, so if you could just hang in there, we'll begin momentarily. Good evening, everyone. It's just about 5 after 7 now, and looks like most of our attendees are here. So we're going to get started. And as you can see on your screen here, this is the Student Loan Consolidation webinar, and this is in part brought to you with the help of the American Physical Therapy Association of New Jersey. My name is Brian Phillips, and I am the Marketing Coordinator and Business Development Specialist with Princeton Federal Credit Union. I'm going to tell you a little about myself here, the credit union, and then get into the meat of the topic here, which is what you're tuning in for, and that's student loan consolidation. I graduated from the University of Kutztown in 2009 with my Bachelor of Science in Business Administration, and started my career off as recruiter in financial services, and after my first year was tasked as recruiting manager to build a team of 5 recruiters as we opened 4 additional offices across the Northeast and Midwest. A little over 2 years ago, I joined the credit union movement with Princeton Federal Credit Union, and my job here has been to bring awareness to individuals about how we can help them make smart financial decisions and really forming those strong financial habits. Princeton Federal Credit Union is a not-for-profit financial cooperative. Basically, what we are is, your financial institution that offers the same products and services you'll find with your national banks, but instead of driving the profits back into the shareholders' pockets, we do take the profits that we earn, and give them back to our members in various forms, such as higher savings rates, lower loan rates, no to low fees on the products that we offer, as well as a full range of electronic services that are free to our membership. I do ask that following this webinar, you do take a few minutes and visit our website to learn more about the credit union, as well as how to become a member at www.princetonfcu.org. We established a relationship with the American Physical Therapy Association of New Jersey about 6 months ago, and we're taking steps to further this relationship and starting that with tonight's student loan webinar and really helping the students in the physical therapy field get a better understanding for what they can do to really help get themselves on track upon graduation. We do have an agenda set to provide you with important information regarding your student loans, whether you're a current student or recent graduate looking at options on a smarter and more manageable payment plan. The student loan industry has become so overwhelming that it's been difficult for us to weigh our options in order to make the best decisions for our personal and financial situations. We're hoping to answer some of those important questions for you tonight, and we will open up the webinar following with Shom on some specific questions that you may have. And at this point, I am happy to introduce Shom Chakravarti to you, who will be our speaker and presenting the information for you tonight. Shom is the Product Manager of Educational Learning with Lemke, who is our partner in the student loan process.
Okay, thank you very much, Brian. I appreciate that introduction. Folks, it's a few minutes after 7 p.m. I also appreciate your time. I know a lot of us are busy, whether you're still in school, whether you've recently graduated, or if you're already in the workforce. So I really do appreciate your time and your interest in finding out more about student loans and more about the Princeton Federal Credit Union as well. So a little bit about myself. All right, so I work with Lemke. I'm the product manager for educational lending here. I did spend some time in the Princeton area. I took 4 years or so to get a bachelor's degree in economics when I was there. And since then, I've been working in financial services in a variety of roles. Currently, of course, I'm at Lemke. I'll tell you a little bit about what Lemke is in a moment. Just so you have a little more color about my background as it relates to educational lending. I also spent a year at a company called Common Bond, which is a recently opened company that focuses on refinancing and consolidating. Prior to that, I spent a few years at a company called Simple Tuition, which is a resource center for student loans and has a lot of information about paying back for the cost of college as well as ways to pay less during the cost of college. But for now, right now, what we're going to focus on is my role here at Lemke. So Lemke Technologies is a cloud-based technology company that powers custudentloans.org. We at Lemke work very closely with Member Student Lending, which is a credit union service organization, and we ensure that our credit union members, such as the Princeton Federal Credit Union, receive exceptional service for their customers. Now, what's CU Student Loans? CU Student Loans is a network of over 200 not-for-profit credit union lenders who use common underwriting and pricing to provide their members with affordable private student loan options. So as Brian mentioned in his introduction, credit unions are perhaps the original peer-to-peer lending. You may have heard this term recently in terms of startups and other currently recently opened companies. Well, credit unions have been doing this for years. It's the original local lender. It's the original way to keep money within the community. And so with CU Student Loans, we have two products. We have the private student loan, CU Scholar Private Student Loan, and we have the CU Grad Student Loan, which provides consolidation options, which is going to be largely the focus of our talk today. So in addition to some information about CU Student Loans, we're also going to tell you a little bit about the federal loan repayment options and some of your federal loan programs that are out there to help you understand how to manage your student loan debt, whether you're still in school, have recently graduated, or graduated a few years ago. And of course, we're also going to talk about the College Resource Center at Lemke. So this is a source for up-to-date financial aid advice. We have blogs, links to other sites, and webinars such as this one. And as there is today, there's always the option to have a direct Q&A, question and answer, with somebody on our team. So let's go into the presentation now. So the agenda for tonight, which we'll try to get to within the next 30 to 40 minutes so that we have enough time for questions and answers at the end of the session. So first thing first is to know your goals. Whenever you're talking about a financial decision, you need to know what your goal is. You folks who are physical therapists, you know that when you're working with a customer, a client, a patient, you need to know what the goal is. What's the goal of this? Is this a conditioned athlete who needs to get back in the game? Or is this perhaps an elderly person who is recuperating from an injury? You need to know what the goal is so that you provide the right service. Similarly, folks like us in the financial industry, when we work with our customers, with our clients, we need to know their goals. And so you need to know your goals as well. What is it that you want to get out of managing your student loan debt? And that sounds like a very general question, but we'll get to that in a moment. So secondly, what is student loan consolidation? So what's that about? There's a lot of misinformation and maybe misunderstandings in the student loan industry. There are multiple reasons for this. One is that the government has constantly been changing programs. So folks here who started out with an undergraduate degree, then moved on to a master or a DPT, you've seen over the last 8-10 years how much the industry has changed, both from the federal loan program as well as from other private lenders. So we're going to try to simplify and give you some up-to-date information on what your options are, as well as talk a little bit about what the goal of doing a student loan consolidation is. So we're going to talk about those options, federal versus private, for example. We're going to give some examples. And to wrap it up, we'll have ample time to go through some questions and answers. So, know your goals. And why is this important? So, like I gave in the brief analogy before, if you're working with a patient as a physical therapist, you need to know what the goal is. Is this patient, again, an athlete who's trying to get in the game within a few weeks? Or is this a person who needs a few months to recuperate from an injury? So similarly, whenever you're making major financial decisions, you need to know what your goal is. So here are some common goals when people talk about saving money. You might be saving money for a car. You might be saving money for a house. Or maybe you want to take a vacation. Now you might ask yourself, all right, why is there 2 pictures that seem to indicate somebody's about to take a vacation? Well, because your goals depend on exactly what your goals are. So if you're looking to take a vacation to the clear waters of the Caribbean, you're going to need to save a certain amount of money. You're going to need to look at that as a certain decision, whether it's a 2-week vacation, a 1-week vacation, 3-week vacation. So understanding that's really important. Sounds obvious, right? And it's a little different if you're maybe just taking a trip to Cleveland, which is where these highways seem to intersect from what my research showed me. So if you're going to Cleveland, maybe you're going for the holidays, visit family, friends, etc. That's a different budgetary consideration. That's a different choice matrix than if you're trying to make a 2-3-week vacation to the Caribbean. So that's important, knowing what your goals are. And the Princeton Federal Credit Union, just so you know, has different options to help you reach these goals. You can have a holiday or vacation club savings account. You can also look at perhaps a money market account to help save money for a down payment on a car, auto lease, or auto purchase, or on a home purchase. So again, knowing your goals. Now that you're either you recently entered the workforce, or you've recently graduated and are looking to start an internship, or maybe you see yourself at the end of your college career and you understand that the working world is in sight, you need to know your goals. Again, with a short-term goal, whether you're just saving up for some holiday cash, because the holidays are coming up in a few months for many of us, or you're looking for a vacation. Maybe there's going to be a nice vacation in January or February. That's a short-term goal. Medium term, you might want to save for a wedding, for a housing down payment, or being able to enter an apartment lease and having the first, last, and down payment of that and security deposit for that apartment lease. Or maybe you think you're starting a family and you want to save some money up for that obligation and responsibility. Longer term as well, as you enter the workforce, you know, it might sound like it's almost too early to think about this, but you do need to think about retirement. And as we're going through these different analogies, know that at the Princeton Federal Credit Union, there are different options for saving for these goals. Again, there's a holiday and vacation club savings account, maybe a money market or a savings account for these medium-term goals where you need the cash within 6 months to 36 months or so, and you want to have that cash at hand. For long-term, you might consider opening up something like an IRA, an IRA, which can help you meet your retirement goals on your own without relying on a third-party pension or 401k through an employer. In addition to knowing your goals, you need to know your numbers. So as a recently graduated physical therapist, these numbers may resonate with you. Perhaps you have a debt range of about 60K to 150K. Those of you who have gone through graduate school, you're going to be at the higher range of this, or perhaps you went to a private undergraduate school, again, you're going to be at the higher range of this. Those of you who may be a few years out in the workforce, or those of you who've just completed your undergraduate degree so far, you're perhaps at this lower range. Either way, you need to know your debt and you need to understand your debt. That's similar to your salary range. Here in the New Jersey and the Northeast region, these might be regional salary expectations for physical therapists in private practice or working with a major hospital network or working with a major school district. Those of you who think you might go into your own private practice, take the entrepreneurial leap, you might not be thinking of as much as a salary range as a potential future compensation range. So there's a good point there. In addition to knowing your salary, you need to know what sort of income do you have. Is it a bond or a stock? Again, another financial analogy. Bonds are considered safer. They're more reliable. But then the return is perhaps less than with a stock. With a stock, it's a little riskier, but that risk also presents the opportunity for more reward. So as you think about what you want to do in your career, you need to think about, am I a bond or a stock with my career? Those of you going to work with school districts, with major hospital chains, you might consider yourself more of a bond. And that means you can take perhaps more risk in other financial obligations you have. Or that means, as we talk about consolidation and looking at your options, you can rely on having a more reliable sense of income. Those of you who are thinking of opening your own practice, it's a little bit riskier, but maybe the reward is there as well. So as it comes to making that sort of financial decision, again, you need to go back a step and think about what are your goals. If you think you're going to open your own physical therapy practice, you need to be saving cash for that entrepreneurial effort. So again, these are things that only you know. You can discuss with your family, with other trusted advisors. Walk into the credit union. Folks there will be able to help you work through these decisions as well. And of course, we here at Lemke, we can also help address, give you some information and address your concerns or requests for more information as you think about these different goals. So it comes back to knowing your goals and knowing your numbers. So with that as the framework, I want to spend a few minutes now on talking about student loan consolidation. So those of you that saw the advertisement or the email about this webinar, you probably saw that, hey, they're going to tell me a bit about how I can manage my student loan payments and how I can keep updated on the various regulatory changes out there, as well as giving me some advice on smart repayment strategies and new methods to manage my loans. Well, consolidation is one of these new methods, these new smart repayment strategies. We'll talk a little bit about this, both from the private and federal level. We'll also talk about federal loan repayment options, and then after that, we'll have some room for question and answer. So, what is student loan consolidation? As the word consolidate implies, this is a way to combine your various student loans into one application, into one obligation. So it's one loan with one interest rate and one monthly payment. Now, consolidating may adjust. It may extend or it may decrease as well the loan term. That's something to understand as you consider this option. And it also will very likely affect your interest rate. We'll talk a little bit about the different options and how these can affect the loan term and the interest rate. So there are two ways to consolidate student loans. There's the direct loans program, the federal loan consolidation program, as well as private consolidation. So financial institutions such as the Princeton Federal Credit Union, they are in a position to help you manage your student loan debt by consolidating both your private and federal student loans into one loan with one interest rate and one convenient monthly payment. So what are the fundamental differences between these two options? Federal consolidation is for federal loans only, those that you've borrowed through either the direct unsubsidized, direct subsidized, or direct plus program. It's also available for Perkins loans, However, those of you with Perkins loans probably would not want to consider consolidating those specific loans as they have different terms. Federal consolidation gives you a weighted average interest rate of your various loans. Anybody who took a PLUS loan in the last couple of years, you know your interest rate's in the range of 7+%. Now, there's no credit check because these are loans that you have with the federal government already. Don't necessarily need a cosigner, and it leaves you the option to keep income-based repayment options that are there for those with federal loans. It's also at a fixed rate. Private consolidation, what Princeton Federal Credit Union is in a position to offer you. Here you can combine both private and federal student loans. You get a new interest rate at the current interest rate market, which is a bit lower than perhaps some of the student loans you might have taken in the last few years, as interest rates were in a very low market interest rate environment. And this is based on credit, so if you have good credit and you want to be rewarded for that, this is a great option. The Princeton Federal Credit Union, we also look at your academic scores as well. So again, if you have good grades, as many of you in the physical therapy industry do, we can reward you for that as well. And you can have the option to include a cosigner on your loan. Now, this is a different discussion that you might have had when you originally took out a loan, when you perhaps needed a cosigner. This may be the option where you have a cosigner on your loan to help you get the best rate possible. One thing to mention, there are no income-based repayment options, but as we discuss the income-based repayment options with the federal government, you'll see that this may or may not be something that will suit your needs. As we go back to the original discussion, it's about your goals and your numbers. Knowing your goals, knowing your numbers, you may realize that some of those federal income-based repayment options are perhaps not suitable for your numbers or for meeting your goals. Another great benefit of private consolidation is that there are fixed and variable rate options, and given the current interest rate environment, that may be something you want to consider. So income-based scenarios. The federal government offers a few income-based scenarios. You may have heard of these. IBR is income-based repayment. Now, what this means is that your federal student loans, the monthly payment on them is limited to 15% of your discretionary income. Discretionary income is your total income less a certain figure which allows for kind of the standard cost of living. It happens to be 150% of the federal poverty line. It's important to remember that this also will potentially extend the repayment schedule of your loans. So if you're looking to pay off your loans as soon as possible, this may not be for you. Pay-as-you-earn is another income-based repayment option. It's for a slightly different scenario, for a slightly different set of federal loans. This limits your student loan payments to 10% of your discretionary income. But again, it also extends the repayment schedule out 20 years. Public service loan forgiveness. Now, this bases a loan repayment option on the pay-as-you-earn program. And what it does is at the end of this 20-year period, if there's any student loan debt remaining, that student loan debt is forgiven. Now, this is good if you work in a public service entity. Those of you who work with or are planning to work with not-for-profit hospital chains or hospitals, those of you working in certain school districts, or perhaps those of you who are even considering a position with a not-for-profit aftercare clinic, something along those lines, this may be an option you consider. And I'll tell you in a moment why it's very important that you consider your career options when you look at these two income-based repayment options. The reason it's important is because you have to consider how much are you going to pay overall. When will I be debt-free? Because, I'm going to go back a slide, if you're extending your current 10 or 15-year loan out to 25 or 20 years, that may not be the best option for you. What options make the most sense? You need goals, and we talked about those goals before. Maybe you're saving for a short-term purpose, maybe you're saving for a long-term purpose. What you want to do is make sure that you don't enter a different student loan repayment option that's going to be a permanent solution for a temporary problem. So if you're just graduating and you're saying, well, look, I'm trying to enter a residency or an internship, so for the next 9 to 36 months, I'm going to be making a different salary than I expect to after that. Keep that in mind. You don't want to forgo a long-term goal of getting out of debt sooner in order to meet a short-term goal of managing your current income during your 36-month residency or fellowship. So again, it goes back to your career options. You need to think about what your numbers are and what you plan to do with your career. Are you going to go into a private practice? Are you going to open your own private practice? Do you think you'll work with a school district, a township, or a hospital? You have to know, is your income a bond or a stock? How risky are your career interests? And so what do you do in order to meet your student loan repayment goals? Going back a step, if you think you'll work in the public service, maybe pay as you earn for your federal loans is an option. If you think you'll open up your own clinic, it's probably not an option. In the sense that it could be an option, but maybe it's not the best financial option for you. So now let's talk about a few of those options. Federal loan repayment options. Standard repayment for a direct unsubsidized, a direct subsidized, a plus loan, it's 10 years. There's a minimum monthly payment, and these are what your federal loans currently are. So in the sense of the loans you already have, this is the loan term that you currently have. Now you have the option to do a few things with those federal loans. You can extend the repayment. You can set up a graduated repayment where your current obligations are perhaps less than your future obligations, depending on your income. Speaking of income, there are a few different income-contingent options. The two most important ones we talked about a little already. It's income-based repayment and pay-as-you-earn. These cap your monthly payments to a percentage of your current gross monthly income less your required obligations, which is based on 150% of what's considered the federal poverty line. So these can lower your monthly payments up front, but remember, you're extending your payment 20 to 25 years, and we'll get to this in a moment, but that remaining loan obligation that is discharged after the 20 to 25 years, that can become a taxable event. So we'll look at an example of this in a moment. Standard repayment. Let's say you took those graduate unsubsidized loans, formerly called the Stafford loans, and you're paying 6.8%. Over a 10-year term, if you have $150,000 in debt, that is to say if you're at the higher end of the average student loan debt range, you're looking at a monthly payment of about $1,700. Interest costs over the life of this 10-year repayment of about $57,000. Now you might look at this number and say, all right, I just graduated, that's a lot of money. So what can you do? You can perhaps consider entering a pay-as-you-earn repayment. Well, now let's consider there's one person in your household. You're making an annual income of $75,000, so a monthly gross income of $6,250. What the federal government's going to do when they enter you into this pay-as-you-earn program is they're going to look at your minimum cost of living. This is based on the federal poverty line, and it's 1.5 times that amount. So it's an amount that says, all right, this is a reasonable amount for a person to make their current required obligations. So they're going to take that $1,400, that's sort of for food, shelter, and those of you in the central or northern Jersey area, I know you're thinking, well, hey, that's probably not going to cut it into this high cost of living area. There are some state-by-state allocations, but let's just assume it's $1,400. So this means that the federal government, when they calculate this pay-as-you-earn obligation, they're assuming that you have discretionary income of about $4,800, and that 10% of that income is available for student loan payments, so that your current pay-as-you-earn monthly obligation is $485. Of course, this is a hypothetical illustration for somebody making this amount of money with one person in their household, and so on. So these are just quick guidelines for those of you perhaps doing calculations at home. Depending on the number of people in your household, you're looking at a range of numbers here for what your required income is. So you can take your existing or expected salary, subtract a number for the required obligations, and that amount of money that's left over, that's what the federal government is going to consider when they calculate your pay-as-you-earn amount. So remember, when you look at your goals, you have to consider short, medium, and long term. So perhaps you saw the $150,000 student loan payment and you said to yourself, wow, that's a lot of money. That's $1,700 a month. I'm starting income of $75K, and I'm still trying to establish a savings account for my for a down payment on a home. I'm still trying to get out of the student loan debt. That's a lot of money. So sure, first year, you're making a $500 payment or so. But as your income increases at, say, an expected 4% increase, your payment increases as well. So by the 20th year, you're paying $1,000. You might say to yourself, hey, that sounds like a good deal. But wait, after 20 years, part of that money is going to be forgiven. However, you may owe taxes on this amount that's forgiven after 20 years. So that $175,000 that's forgiven, that becomes income. Those of you making student loan payments right now, you know you're getting a form from your servicer that you can use to deduct student loan interest. Now the opposite applies. If your student loan interest and principal is forgiven, that becomes a taxable event. So you may be looking at a scenario 20 years down the road where you're forced to pay 20, 25, 30% of income tax on this forgiven amount. Something to consider as you look at this option. Now, if you enter a public service job and you're working there for 20 to 25 years, that amount of loan debt that is forgiven, it won't be taxed. So that is an option for you on your federal loans. But if you're not planning on working in the public sector for 20 to 25 years, you have to outweigh the pros and the cons when you make this decision. You have to consider the reduced minimum monthly payment in the near term and the increased cash that it gives you for the near term, with the idea that over the life of the loan, you can be paying a lot more in interest, and that you may owe taxes on that forgiven debt amount. So what is your other major option? Let's talk about what the Princeton Federal Credit Union is in the position to do for you. Here we also offer student loan consolidation. Unlike the federal government, you're able to consolidate both federal and private student loans. So that gives you the convenience of having your various student loans from your freshman year through the final year of your graduate degree program into one application. And note, to consolidate, you do have to have graduated. So those of you who are still in an educational program right now, this is something to consider after you graduate. It does offer you one monthly payment through a convenient portal that we help offer the Princeton Federal Credit Union. And it is a credit-based application. So those of you who've been responsible with your credit and you want to be rewarded for that with a lower rate, this may be an option for you. You're able to learn more here at this link. It's custudentloans.org, which powers the Princeton Federal Credit Union's CU Grad Scholars Loan Program. So custudentloans.org, Princeton Federal Credit Union, #CU Grad. So those of you who haven't seen this already, you see there are variable rates ranging from as low as 3.97 to 7.47. It is subject to a floor rate, 3.75. Those of you who want to know the other side, there's also a cap. It's capped at 18%. That's something that'll happen down the road. Right now we're in a very low interest rate environment. So this is based off a financial interest rate called the 3-month LIBOR. It's a rate that banks use when considering making loans to each other. We're also using it to base the loan rate that we would offer to graduating or graduated students who are looking at a private student loan consolidation. So if you have great credit, you may be paying rates as low as 3.97. As you go through the credit range, you'll see a current range of 7.47. Those of you who are paying 7.9 for the Grad Plus loan, you know that's still a savings. And it also offers you the convenience of a 15-year repayment plan, which can be graduated. So there's no origination fee. So those of you who are still hurting from the 4.3% origination fee on the Grad Plus loan, you can be rewarded and comforted knowing there's a 0 origination fee with this product. There's a rate reduction if you set up auto payments, 25%, 25 basis points, 0.25% to do that. There is a graduated interest-only repayment option available. So perhaps a few of you are thinking, hey, I like the idea of all these different federal student loan options that help me get a lower payment option right now, because I'm about to join a residency or an internship where I'm going to be making a little less money over the next 3 years. Here at the Princeton FCU, there's also the graduated repayment option available in the sense that you can choose to do 4 years of interest-only payments followed by 11 years of full interest and principal payments. And as you think about your goals and as you think about your numbers, you may find that this is a very good option. Because remember, some of these federal student loan income-based repayment options, they are permanent solutions to temporary problems. You might have lower cash flow right now as you enter the working world and are trying to save for housing, auto, family, etc. But you want to consider the fact that it's extending your repayment out 20 to 25 years. So if you've worked hard to enter a fast-growing and stable career, that may not be something that you want to do as you consider your numbers, your future salary options, and your future considerations. Again, you're looking at opening a private practice perhaps, as many physical therapists are. Do you want that 20 to 25 years of student debt out there as you consider your obligations for starting your own business? Something to consider that you can discuss with yourself, with your family, trusted advisors, including those at the Princeton Federal Credit Union or us. There's a way to reach us, which I'll link to our email address and a resource center at the end of this presentation. And there is a cosigner release option available. So those of you who've just graduated, maybe your credit isn't there yet. After 12 months of on-time, regular monthly payments, you can apply to have that cosigner released from your loan. So you're starting out now, maybe you want to keep a cosigner available, but within a year or so, your own career is taking off, you get the job you want with the hospital, with the school district, with the private practice. At that point, you're making savings decisions for yourself. That might be a good time to consider releasing the cosigner from your loan. And again, we talked about the variable rate. It's based on what's called a 3-month LIBOR. You can look this up online. It's currently 0.23%. So if you've locked in an interest rate of 7.2% or so, you might want to consider a consolidation option, which is going to reward you for the current interest rate environment, which is historically at a very low interest rate schedule. So here's some scenarios. How can this save me money? You say, I want to see some numbers. So right now, let's consider you have a few different loans. You went through 6 to 8 years of school, so it's adding up to $150,000. You're paying an average rate of 8%. Your current monthly payment that you're looking at is $1,800 or so over a 10-year term. Now, if you consolidated that with us, you have two options. You can do level repayment, where over the 15-year life of the loan, you're making one payment of less than $1,200. Or you can look at a consolidated graduated repayment option where your first 4 years, you're going to be making interest-only payments at a lower interest rate of 4.75%. And once you finish your residency or once you finish establishing yourself at the school district, you've saved money for some of your personal savings obligations. Now you start paying that loan down. So 5 to 15 years down the road, you've paid off your loan. At this point, you have a family. You've paid off your loan, and you're helping your children perhaps save for their own college. So noting that there's about 20 minutes left, and I do want to get to some questions and answers. At this point, I'm going to just ask, before we get into some budget scenarios, I'm just going to reach out to the audience and ask, are there any questions? You should have the option on your webinar panel to send me questions. So I want to take a minute or two just to see if there are any questions. So anyone who has questions, please write it into the question and answer panel. We'll try to reach some of those right now. And then what we'll do is, if there aren't too many questions, we'll go back to finish up this presentation. If there are, we'll take about 10 minutes of questions, finish up the presentation, and leave the last few minutes open for questions. So anyone with questions, I'll give you another minute or so if you want to just type it into the webinar panel to the it's probably the right of your screen. Okay, I've seen one question so far. Somebody wants to know if they are only if they only have federal loans right now, are they still eligible for private consolidation? The answer is a resounding yes. So private loan consolidation, you're able to consolidate both private and federal loans. You can also choose to consolidate only federal loans. So what this can do for you, especially you folks who've gotten graduate degrees, it'll give you the convenience of one monthly payment. So you take your subsidized loan from your undergraduate years, you take your plus loan from your graduate years, you combine it into one loan under one servicer with one institution. And we'll make, not only will we make that more convenient, but we can lower the rate. We can drop it down perhaps to as low as 3.97 for those with great credit. Okay, another question, and this, actually a few questions are coming up now, so I'll get to some of these. Okay, I hope I answered your question to the first respondent there. Do you have to wait to finish until your graduate program is finished? Yes, you do need to wait until you finish graduating. In a consolidation option, the underwriter, the loan servicer, we will take a look to make sure you've graduated. And that's one of the reasons why you might get a much better rate, because we're rewarding you for your new credit rating at this point. When you first took out a loan at the age of 18 perhaps, and it was a direct subsidized loan perhaps, you're paying a different rate, and that was on a different credit risk than your current credit risk. So you do have to wait till you graduate, but this could be something for you to consider as you look at your different loan options. Now, I do want to mention the Princeton Federal Credit Union also does offer in-school loans. So those of you who haven't taken a loan out yet for this year, or those of you who know you're going to borrow again next year perhaps, or this winter for the second semester, some of you may be in an internship program where you didn't need to borrow this year because you were working in a co-op, but you know you're going to have to borrow once you go back to school. Yes, you are able to borrow through the Princeton Federal Credit Union for an in-school loan, and you do get a lot of the same service, lower rate options, co-sign release. That is available through the consolidated product here. And again, once you graduate, you can take that loan, combine it with your other private and federal loans into one low monthly payment. Another question, and it's a great question, are you penalized for early repayment? No, you are not. And as we talk about these budget scenarios, you'll see one of the great things you can do with a consolidation where you take your monthly payments down from $1,800 or so to, with a new lower payment of $1,200 or so, you can take that extra cash and meet your own personal goals based on your numbers and your desires. So if you want to accelerate that debt elimination, you can take that extra $653. We'll make sure it goes to the principal of your loan, which is a responsible feature to offer, which helps you pay down that loan even sooner. So you take that $653, maybe you pay down your debt. Maybe it goes towards savings, so you can open your own practice, so you can save for a car to get to the various clinics in your hospital network. Maybe you can save for a house, etc. You can use that extra cash. Some of it goes to savings, some of it goes to debt repayment. You do with that extra cash what you need to do to meet your goals based on your numbers. So another question. So what's the difference between the Princeton Federal Credit Union and something like Sallie Mae? So Sallie Mae is actually a private organization. They do a lot of work with the federal loan program. I want to make it very clear. For some of you, this is obvious. For some of you, it may not be. Sallie Mae is not a federal entity. They were in the past. They kept that sort of name, Sallie Mae. Sounds like Fannie Mae, sounds like Freddie Mac. None of these organizations are actually federal entities. So the difference between an organization like the Princeton Federal Credit Union and Sallie Mae, it goes back to what Brian said in the beginning. You're getting a different level of service. We're doing this webinar here with you, and we're talking about your various options. We're telling you what the federal loan options are because we're being perhaps, we're close to you, geographically speaking, physically speaking. We want to give you responsible advice. You're probably not going to get this kind of information from Sallie Mae unless you have a federal loan, in which case there are at that point they will tell you about your various income repayment options, but they're probably not doing webinars like this. So Grad Plus loans through Sallie Mae, It's actually a loan from the federal government that is serviced by Sallie Mae. One of the great options of consolidating is if you started your undergraduate program, let's say you went to school in Pennsylvania for your undergraduate and you came back home to New Jersey for your graduate degree, you might have two different federal loan servicers because Sallie Mae services some federal loans and an organization called FIA services some other federal loans, especially those for people who went to school in Pennsylvania. So the great thing about consolidation is you take your various federal loans, the unsubsidized from your master's degree program, the grad plus loan from your master's or graduate or doctoral degree program, plus your subsidized loans from your undergrad program, you put them all into one convenient place. So can you get a quote from the Princeton Federal Credit Union? Sure, once you start an application, it doesn't obligate you necessarily to complete that application. So you can understand what your rate is based on your credit history, based on your total loan payments, and from there make the responsible decision either by speaking to our customer service team here at Lenke that helps the Princeton Federal Credit Union provide great customer service, or you can just take a look at the numbers, speak to somebody at the Princeton Federal Credit Union that's there to talk through some financial decisions with you and definitely see, is this the right decision for me, without being under any obligation to automatically consolidate your loans with us just because you expressed some interest or started an application. Okay, so there's about 15 or so minutes left. I'm just going to go through a few different options. So in terms of different credit unions, you can take a look at the CU Student Loans Credit Union, the Student Loan Resource Center, see what the options are there. If you currently have Sallie Mae for your federal loans and your high interest private loans, you've got a couple options. And I want to make it clear you don't need to consolidate or refinance all of your loans with us. You can choose to consolidate or refinance those higher interest rate loans, perhaps the Sallie Mae private loans if that's what they are, or some of those grad plus loans that are in the 7.9, 6.2% range. You can consolidate them to a lower range and perhaps keep your undergraduate loans that may be at a lower rate, or your Perkins loan that is at a lower rate. You can, that may be at a lower rate. You can choose to keep those separately. You do forego some of the convenience of having all your loans in one place, but you take the advantage of having those higher interest rate loans at a new lower interest rate. So again, it goes back to your numbers. When we talked about numbers, we said debt and income. Your outflow, your inflow. You can think about your numbers, and you can think about your goals. So again, if you can choose to aggressively repay certain loans and perhaps keep other loans at a longer repayment schedule. So maybe you take those high interest rate loans, take them to a 4 plus 11 year graduated repayment consolidated loan with us that offers you 4 years of interest only payments plus 11 years of full payments. In the meantime, in those 4 years, you're thinking of your own numbers and what you want to do based on your monthly take-home, based on your existing debt payments, your bills. Again, it comes down to what is best for you. So with about 10 minutes left, I just want to quickly go through another few minutes of this, and then again we'll have some time for questions. So debt repayment strategies, and this is really important. And I alluded to this before. Somebody asked, what happens if I repay my loan earlier? There are no penalties. So if you choose to take a 15-year loan with us, something to consider is that there's a creative way to think about this. So it might not only lower your interest rate from your 7.9% grad plus loan, which many of you may have, you can lower your interest rate because you've extended the repayment schedule. Now your monthly payment is lower, and you choose what you want to do with that money. Maybe you take that money and you pay down your loan quicker so that it's not a 15-year loan, but it's actually a 10-year loan. Or maybe you keep the 15 years, you're at a lower rate and a lower interest rate. I mean, you can't beat that. If you take a 7.9% grad plus loan, refinance it to a lower interest rate and a longer repayment term, I mean, you're saving on both ends there. Now you do what you want with the cash, and it opens up some opportunities for you. Those of you who work perhaps in a school district, again, think about what is your income. Is it a bond or is it a stock? You work in a school district, a safe school district. You have a reliable, comfortable position. You can choose to repay your loans sooner on that basis, depending on your personal financial tolerance, because you know that you have a steady job and you know you're going to live in that town for a while. You're involved with the sports teams, you're involved with the arts programs as well, and you want to get involved in the town, you want to buy a nice house, set up a family there. Think about what your own personal goals are. If choosing graduated repayment gives you that option, so you make interest-only payments for 4 years, you start saving money. You buy a house in a nice school district where you got a great job with a great school, or perhaps you're in a hospital network and you've got one location in downtown Princeton, you've got one location on Route 1 in Lawrenceville, you've got one location up Route 27 in Montgomery. You want to be at a location that's convenient for you, and you want to have a great car for the commute. Maybe that's your personal savings goal. So consider that. And maybe you don't need to enter graduated repayment for that because it's a lower savings goal that you have. Maybe all you need to do is refinance, consolidate your loans into a lower interest rate. You take that $600 you're saving a month. In 5 or 6 months, you've got a down payment. You go through the credit union, you get a great auto loan. You're able to buy that nice car so you can shoot up and down 27 or Route 1, except when there's traffic, which we know there is sometimes. And at that point, you say, all right, well, good thing I got a convertible because I'm just enjoying the nice sunny weather here on Route 1. Sometimes that can happen. Maybe not a day like today, but a couple of weeks ago, it was great weather for a while. Maybe that's a good option, especially those of you shuttling around to different athletic events on Route 1 and Route 27 and so on. Again, you gotta figure out what your own personal goals are and meet those goals. So you use that extra money that you gain from consolidating or from choosing an accelerated repayment strategy, and you do what you need to do with that money. It increases your cash. It allows you to look at other financial products. Perhaps you're saving more. You're putting money into an IRA. So how do you get ready for consolidation? Well, first, some of you have asked, you do need to graduate, but don't forget about your undergraduate loans. And if you still are an undergrad, consider these options. It's great to know what you have as an option as you consider your career options. So maybe those of you in undergrad were saying, look, I can't enter a master's degree program. I can't enter a DPT because I have to pay off my undergraduate loans. Well, look, maybe you can, and maybe you have this information now. You speak to your family, you speak to friends, to advisors, academic advisors. Say, hey, do I do that master's degree program? Do I enter that DPT program? This is what I'm thinking of doing. I want to move back to Jersey. I want to work with the school district. Does it all make sense? I want to open my own practice. Does it all make sense? Now you have more information to make an educated and informed decision about what's right for you. But moving up a step, let's say you are really close to consolidation. First step is look at where you are. You need to see what your different loans are. Are they with private loan servicers? Are they with federal loan programs? What are your rates? What are you going to gain by consolidating? And again, especially for an audience like this, you need to consider your employment, your income. You folks are in a great position. You've got a lot of education behind you. It's a career in demand. Perhaps some of you have changed your career goals since you first entered. I know a lot of friends that went into physical therapy that I spoke to in high school. Started out, hey, I want to work with the school district. I want to work with athletes, etc. Perhaps you did an internship, you did your fellowship, you did your residency, you did your master's degree program. You have different goals. You want to open your own practice. You want to work in a different area. Geriatrics, as it is, another fast-growing area that you have that opportunity to go into. Think about the money, the career, the future goals you have, and think about what consolidation means for you. It can open new doors. Again, a lot of you folks perhaps considered opening practice, considered going to graduate school, and thought, I can't. I've got $50,000 in loans because I went to Scranton, I went to Northeastern. I can't go back to start a doctoral degree program. Maybe you can, now that you know what your options are to manage your student loan debt. So, last few minutes, questions and answers. I'm going to leave 5 minutes open to make sure that anyone who had questions and answers can ask those questions and get some answers. But again, we're here for you, so we'll be on the line for a few more minutes after that, as long as there's some questions and answers. I do realize it's, for most of you on the East Coast here, I'm sure at this point it's 8 o'clock. You want to get to dinner, or you want to get to studying, or you need to get to that school obligation, either for your clients, your customers as students, or perhaps your family members. So let's go through a few more questions, see what we can help answer for you. Any other questions folks have, please feel free to reach out to us right here online. Okay, I'm not seeing too many questions. I'm seeing a number of attendees are still interested and engaged. Just going to show some links on the screen for you. First, if you have any questions or comments, please feel free to reach out. This is me, shom@lenkey.com. We help Princeton Federal Credit Union offer these student loan programs by both helping out on the front end, the technology side of the application, as well as on the back end, making sure that there's great customer service for you folks as you go through the application and once you are a customer, a borrower with us. You can reach out to Brian here at the Princeton Federal Credit Union. Here's the link to their direct site. I want you to notice it's a .org because, again, there's a non-for-profit credit union. The money here that you're borrowing, it's going back to the community. It's building businesses. It's lending, so those of you who are customers already, you know the various auto loan options you have, personal loan, mortgage loan options. It's going right back to the community. So something to think about as you consider where your dollars are being spent and where they are being kept. Here at the custudentloans.org site, we've got a college resource center. Now, this is a great resource center. It talks not just about consolidation. It talks about new student loans. It talks about your different debt obligations that you have and debt options you have to repay those student loans. It talks about a lot of different things that you folks who've taken the interest, the initiative, and the money to go through schooling, this might be a good resource center for you to keep apprised of various updates. Also, just take a look at it now, see what's on our blog, and see if you have any questions that we didn't get to answer or that came to you later. You can either reach out to me, you can reach out to Brian, or you can take a look here at the College Resource Center. Okay, so a few folks are asking about some of these pay-as-you-earn options. And a few folks are asking for general questions. So quickly summarizing, what's the difference between the private loan option and the federal loan option? So it really comes down to two things. One, where's the money coming from? With this option, the money is coming from the community. It's coming from the Princeton Federal Credit Union. With the federal loans, it's coming from the federal government, the tax dollars. Now what that means is if you choose to enter any of these income-based repayment options, at the end of that 20 to 25 year repayment period, that amount of money that was forgiven, taxpayers need to get some return on that. So some of that money can go back in the form of a tax bill that is due. So basically, when you think of federal versus private loans, it comes back to the federal loans having some of these income-based repayment options that are based on extending the repayment schedule. having a fixed interest rate, which could be good in some ways, but perhaps having a higher interest rate. You consolidate with the federal loan program, you're keeping your interest rates. They're going to average the two interest rates together, basically. So you took a few years of loans at 7.9%, a few years of loans at 6.8%. Your consolidated interest rate is a average of the two. Whereas with a loan like this private option, your interest rate is based on your credit, your schooling. So if you've been responsible in that respect, you can take a look and see if you can get rewarded for that responsibility. So that's the main difference really to those two options. And it's about folks who already have these loans. So if you already have a number of private and federal loans, a lot of you folks who've gotten your DPT or your master's degree, you've gotten 8-9 years of schooling. Maybe you have 16 different loans. This can consolidate them into one place with one payment. It seems like a few questions were around that. So in terms of this information, we're going to reach out to you. We'll keep you apprised of the situation. You can take a look at the College Resource Center. A lot of this information is there. You can always reach out to us directly for questions. We may be able to pass on some of this information as well. Okay, somebody's having a hard time figuring out the pay-as-you-earn, how it works. So I'll go really briefly, and I'll also mention for a lot of you folks who've taken the initiative to go through this schooling, it may not be a helpful option for you in the end. So basically what pay-as-you-earn says is it says, okay, you've gotten through your education, you've incurred a certain amount of student loan debt. It's really better for people who are in lower income situations, which even those of you starting out, you can be happy to know you're probably, and I don't want to be presumptive, but as a physical therapist, you're probably not in a very low income situation. But pay as you earn takes a look at that situation and says, all right, what does somebody need to pay in order to meet their basic requirements, their food, their shelter, their clothing? So it takes a look at the poverty level, which is how a lot of different federal programs, and I don't mean federal loan programs, I mean federal beneficiary programs such as what's called welfare, such as what's called WIC and so on. Great programs to have if you need those. So what it does is says, all right, here's the poverty line which determines eligibility for those. We're going to take 1.5 that poverty line. So we're going to say, okay, a person is at a certain level of income which allows them to not only meet what are basic requirements, but perhaps a few things there as well, because they are professionals and they do have certain obligations. So it's going to be 1.5 of that obligation. So I can go back to the numbers. If you let me go out, we're going to see the PowerPoint presentation is raw form. I hope you don't mind. Let me just go back to this. So these are the numbers. So let's say you've got 4 people in your household. This is what's 1.5 times that guideline. In New Jersey, you think about your different obligations, and you can say, all right, that's going to get me there. $3,000 a month. It's going to cover rent. It's going to cover food, shelter. But I'm going to, if I have student loan payments, it's going to be tough to make payments on that amount of money. If you're earning that amount of money, you and the other people in that household, it may be good for you. If you're just starting out, you're the only person in your household, 1.5 times the federal poverty guidelines of $11,500 or so is about $17,000. Now, as you think about entering a federal repayment option, again, consider your overall numbers. Pay as you earn is great up front, but it's going to extend your repayment out 20 to 25 years. If you're not working in a nonprofit hospital, if you're not working in a school district where you're capping your salary, and those of you, to be honest, who are working in New Jersey or Eastern Pennsylvania, school districts here, they're good options for physical therapists. You're going to make a reasonable salary to start out. It's a relatively safe salary. I'm not speaking for all school districts. I'm just speaking, conventionally speaking, as we in the financial services industry try to provide advice. We often say, know your situation. If you're working in a school district, your income is more like a bond. It might be lower to start with, but it's safer. You might be thinking, hey, those other guys and girls in my class, they went to work for that sports clinic. They're making a lot of money out of the gate. Hey, if you've chosen to work with a school district, you've gotten a different situation. You may have some more personal rewards working in a school district. You may have some more personal rewards working in a hospital facility, and your income might be lower, but it's perhaps safer. So pay as you earn, even in that situation, even if you are working in a non-profit situation, may not be the right thing, because you might see that you're just extending your loan obligations out 20 to 25 years. And I want to close on that particular question. I know I spoke a few minutes on that because there are a number of people asking about that. Here's a great resource for you. It's the studentloans.gov site. You go to this link. You can also search for it. I wanted to provide it for you directly. This is going to give you an idea of what you would be paying under the different pay-as-you-earn income-based repayment options. So again, you can go right to this link here: studentloans.gov, My Direct Loan, mobile repayment. I'm not sure if you can copy and paste this. Looks like you probably can't copy and paste that from the presentation, but look, I'm leaving it open for you. And we will be emailing you. We will provide you with these resources, some links to our College Resource Center, some links to the Princeton Federal Credit Union, direct emails for us so you can ask these questions offline. So if you're not sure if you're eligible, here's a good way to check: studentloans.gov, My Direct Loan, mobile, because it is mobile friendly, repayment estimator, not action. So those of you who are on your computer, you can go to this site right now on your phone. So looks like we have a few more questions. They're general questions about these options. I hope I've answered them. I know a lot of folks are looking to say, hey, it's past 8 p.m. I'd like to leave soon. You're definitely free to leave. We will follow up with you by email. And also, I apologize, I am overcoming a cold. As happens in New Jersey, the weather goes from 90 degrees to 50 degrees in a matter of 2 days. So if I was a little scratchy, if I was cutting in and out, I apologize for that. You can reach me directly, shom@lenke.com. You can reach Brian directly, bphillips@princetonfcu.org. We'll be able to answer your questions or provide you with links, guides to some of the resources out there for you. Great question. I actually realized was a new one. Somebody said, what if I've already consolidated my loans with the federal government? You can still consolidate your loans with us. A lot of you probably heard that advice as you're graduating from your financial aid office, and they told you, hey, you've got this small window to consolidate your student loans. It's the only window you have. A few people have already left. This was a great question. I hope I reached out to everyone who wanted to know this. You can still consolidate your loans. Even if you've consolidated your federal loans through the Federal Direct Program, you can still take those loans and consolidate them through the Princeton Federal Credit Union. Great question. I missed a few people who probably would have wanted to know that. I hope I've reached everyone with that question. In fact, Brian, let's make sure we know that when we send that email out to the folks here, we know that everyone who's been on this call knows they're able to still consolidate their loans if they've already gotten a federal loan. In fact, on that note, for a few of you who are still here that are going to say, hey, I'm still in school. I just got a student loan through the federal government. I want to know if I can still get a student loan through the Princeton Federal Credit Union. Like what you folks are about. I see that it's a better rate. How do I do that? Great news. The federal loans offer you up to 120 days from the date of disbursement to cancel your student loan with them at no fee and with no penalty. So if you took out a loan at 7.21% because you're in the because you're in a graduate degree program, and you went beyond your direct subsidized limit of $20,500, as most of you, actually even those of you at Rutgers, I'm sure, are beyond that limit for your graduate degree program, and you've taken out a Grad Plus loan at 7.2%, you can cancel that loan. You don't have to pay the 4.28% origination fee. Your school's financial aid office will tell you how to cancel it. It's actually really simple. They take the funds that have been dispersed to you. You can keep those. You can apply for a loan with us. Once you apply for a loan through the Princeton Federal Credit Union, right here, start here, princetonfcu.org, go through the links. You'll see how to apply for a loan. You can actually take a loan out. Once you see you're eligible with us, you can cancel your federal loan. You don't owe that 4.3% origination fee. You don't have to pay 7.2%. You get a lower rate with the Princeton Federal Credit Union. And even if the rate is similar, even if you're in that 7% range, it is not a 4.3% origination fee. So that's great news to look into. I don't know how much of the audience is still in school, so I don't want to speak to that too much. But check out the website. You'll see what options are available to you. Let's see, a couple other questions. I think most of them have been answered. Okay, this is basically it. We've answered that pretty much. To make clear, yeah, there is no origination fee on private student loan through Princeton Federal Credit Union. So again, great option. So those of you who've been listening to this whole presentation and have been saying, that's great, can't wait to do this once I graduate and still in school. And Brian, we should mention this to folks in the email as well. Hey, you can actually cancel your federal loan with no penalty, get that 4.3% back, take a loan out through the credit union at a potentially lower rate with no origination fee. Anything else you can do to lower the interest rate besides refinancing, consolidating? Well, what you could do is kind of the option I just mentioned. So those of you who are in your final or later years of school, you still could at this point. It's the middle of September. You have 120 days from when you first got your student loan disbursement to cancel that with no penalty. Something to consider. A couple other questions are coming through. Summarize the difference. Okay. So it's almost 8:15. I do respect everyone's time, and I do appreciate everyone who took the time to hear what we had to say about your student loan repayment options. Again, to summarize, we'll go back to the first principles. You need to know your goals. You need to know your own numbers. There's a lot of information out there. Some of it's on sites like ours at the College Resource Center. Some of it's available through the Princeton Federal Credit Union. Those of you who are customers, you know that you have the option to take a total picture of your obligations through the tools that they have for existing customers. Definitely take the time to speak to somebody about their e-services through Finance Work, if that's Finance Works, if that is something you want to do. Those of you who are considering becoming customers, take a look at the website, see what great options there are. Remember that the money is staying with the community. It's something to consider as you think about where you're doing your banking and where you're taking a loan from. So in addition to that, we will reach out to you folks who have joined us for this call with links to finding out more about the federal loan options, finding out more about student loans through the Student Loan College Resource Center, and more information where you can reach out to us with direct questions. Okay, it looks like that's about it. It's 8:15. I do appreciate everyone's time on this weekday evening. I do apologize for my slightly under the weather, bit of a raspy voice. You're in New Jersey, you know how it is. It's 50 degrees today. It's 90 degrees over the before last weekend, so that happens sometimes. All right, folks, I do appreciate your time. I'm just going to end it here. Brian, I'll give you one last chance to say goodbye on behalf of the credit union. Go ahead and do that, Brian. You've got a few. You've got a minute left, a few attendees left to say goodbye. All right, Brian. Okay. I'll say goodbye on your behalf, folks. We're going to email you again. I do appreciate your time. Have a great evening, and if you have any questions, feel free to reach out directly to me or Brian. Shom@lenco.com. Sure, Brian. We can hear you. You've got a.
Hey. Yep. Yeah. Sorry about that. There. Some technical difficulties. Just wanted to say thanks again, for presenting this information. I think it was great, and those attendees that have joined us this evening, the information hopefully is new to you and has helped with some of your decision making moving forward. We will follow up with an email with the contact information, some links and information, just wrapping up what we went over today. And feel free to, of course, reach out to myself or Shom with any questions via those email addresses listed. And again, check out the website, princetonfcu.org, custudentloans.org. It's a great resource to utilize in making those very, very important decisions.
Great. Thanks, Brian. And thank you, everyone. Have a great evening. Take care. Bye.